Hey everybody, it's Daniel here from InfoVest. Hope you're all doing well. So we got the Fed coming out today. They came out already, discussed about monetary policy. They left rates where it is right now. Didn't hike, didn't cut, just remained unchanged. So what did we get? What happened in the equity markets, the bond markets? What did Jerome Powell say about the future of the US economy and its interest rates? And the money printer as well. So first things first, the equity markets did rally, the bond markets as well, all went up. Gold, Bitcoin, all the assets were basically, a majority of them were up today. And that was on the back of a particular line talking about QT. Right, so the tightening of money is now being slowed down significantly, which is a positive sign for bonds and stocks because it signals the move that, okay, we're eventually going to be ending QT, and then the next phase after that will be the printing of money, right? So that basically caused the equity markets to move up higher, and as well as the bond market, right? We also seen that when you look at the summary of economic projections, we saw an update where we're seeing kind of stagflation, and we're seeing basically growth being revised lower, GDP being revised lower, and a little bit of a pickup of inflation and a little bit of pickup of the unemployment rate. So, you could argue that the projections are signaling weakness in the economy. You could project that you get mixed kind of feelings about the projections there, and in terms of the interest rate changes, nothing really changed in terms of the future outlook. That was kind of seen a little bit more hawkish for this year. However, the markets are pricing in, before they're pricing in basically a 55, basically 0.55, basically the rate cuts happening twice this year, and that has moved up from 0.55 to about 0.65, right? So 55 bips to 65 bips now. So so the markets really took this in more of a dovish manner rather than a hawkish one. How I perceived and saw the whole meeting, I kind of saw it more of on a hawkish side of things, and I'll explain in a bit why I think that. So there were a couple of lines that kind of got to me that I thought was a little bit more on the hawkish side, and was surprised to see the move higher in the equity market. So the first things first, Powell said, he doesn't need, in the conference, doesn't need to be in a hurry to adjust policy stance. There's no hurry for that. All right, so that should be considered kind of hawkish because you're slowing down QT, but you're still, doing QT, and it's just at a slower pace, and the rates are kind of staying where it is. So there's no rush. Powell also said waiting for greater clarity. Now around tariffs, you could see, tariff inflation coming in, but it all depends how this trade war goes, trade talks go. So that kind of leaves uncertainty for the Fed of what to do. But they're ready to do something and act quickly if that is the case. What was very funny and interesting is that he said the base case is that tariff inflation will be transitory. Okay, how many times have we heard the Fed talk about inflation being transitory and being wrong about it, right? I mean, they've always had that kind of horrible track record. So it'll all depend on inflation, depend on the tariffs. We'll be working separate from tariffs and non-tariff inflation. It's too soon to decide what is going to happen and what to say. So they need more clarity. They have no idea what Trump is going to do, etc., etc., etc. Right? so that you could argue, okay, the uncertainty, not being kind of dovish and saying that they're worried about the economy, kind of just neutral there. You could argue that the fact that they're not preemptively kind of signaling lower rates, cutting rates, you could see it more of a hawkish kind of thing. But the markets didn't see that, right, today. The market saw it more dovish, especially on the QT side of things. You mentioned also QT being more, the adjustment being more of a technical adjustment. That was pretty interesting because we saw something like that in terms of the balance sheet change in 2019 before the 2020 crash. And the reason why we saw the technical adjustment is because Powell did say seeing some signs of tightness in money markets. Thus, the technical adjustment, right? So don't forget, in 2019 we got exactly the same words where we got technical adjustments to start doing QE, non-QE, QE, start providing liquidity in the system, right? Because there's tightness in the money markets, right? So he did confirm there's tightness in the money markets today. He did say that this is a technical adjustment, and that is because he's seen a slowdown. He's seen the tightness in the money markets, and obviously he can see things that we can't see that can pose a risk. So that was pretty interesting there, that maybe the bond market picked it up, and that's why we also got this continuation of a rally in the bond market. But it's interesting, the equity markets, yes, after his press conference we got a little bit of selling, but nothing back to an aggressive sell-off. We could see something. We'll see tomorrow how the equity markets play out, but it's just interesting, that comment that he made, because that rings a bell, just like in 2019, very similar comment. And lo and behold, right, what did we get after 2019? We got 2020, the COVID situation. Then we got the stock market to plunge. So whenever you see these tightness in the money market, it's not generally a good sign. So again, the weakness in the economy, this has to do the weakness and the sentiment around the financial markets and the economy. Other than that, Powell did say a chance of a recession has moved up, but is not calling for anything disastrous. However, poly markets see a basically 38% to 40% chance of a recession this year. But Powell did acknowledge, yes, the chance of it has moved up, which is, all these signs are basically good for bonds, right? This is basic positive for bonds, right? Recession, fear, money markets tightening up, now moving from QT to less QT to eventually easing, right? These are all positive for the bond market. The only question is, what the hell is the equity market doing, right? I mean, the equity markets can remain irrational longer than you and I can remain solvent. So the equity markets can do whatever it wants to do, but I don't quite agree with the rally that we saw in the stock market. I think it will be short-lived, and I don't think it will hold, because I didn't see this as dovish or anything good when it comes to everything that Powell said today. So in addition to what else he said, he said it's appropriate to wait for some clarity. The costs are low, overall labor market's in balance. If you look at 5 years or 5-year forward, you will see that break evens are either flat or slightly down. If inflationary impulse will go away on its own, it's not the right thing to tighten policy. We're well aware of what happened with the pandemic inflation. We'll keep that in mind when we have to reestablish price stability. There's always possibility of a recession. We don't see it's elevated. Chance of a recession. Chance of a recession has moved up, but not high. So just like I said. And talks about University of Michigan inflation expectation rise is an outlier, but we take notice, right? So it's completely ignoring that. Just like the whole inflation is transitory thing. So here's the thing, right? At the end of the day, I mean, the Fed has always got it wrong, okay? When did they get it right? And we heard it before. Inflation is transitory and being completely wrong, okay? The biggest thing that I think that the takeaway here is that it was more, in my opinion, hawkish. I didn't see any reason for the equity markets to move up, but let's not get ahead of ourselves and try to fight the markets because, again, like I said, markets can remain irrational longer than you and I can remain solvent. So the first things first, I thought it was more on the hawkish side of things. And second thing, I think can't believe no one's really talking about this and there's not enough light around this specific comment, is that this was a technical adjustment and that there are some signs of tightness in the money markets. It's like he's leaving breadcrumbs, just leaving breadcrumbs and showing you, hey, wake up. This is little bit of breadcrumbs here and there of where this is going, and it's just obvious, right? So you see that even in the projections, the lower GDP, the little bit higher unemployment rate, you have inflation ticking up, tariffs, trade war, the yield curve, the bond market, the money market tightness, right? The rate cuts, and then the end of QT eventually, which again, just look at cycles. It always tends to quite often, maybe not exactly repeat, but often rhymes, right? So pretty interesting day. Let's see what happens tomorrow, how long this rally lasts. The equity markets, when you look at the S&P 500 on the daily, it's on a technical resistance level. Let's see if it can break it or not. And we'll continue to monitor the data. And let's not forget, April 2nd, that's when Trump comes out, talks about reciprocal tariffs. Will it be pushed? Will he go through with it? We'll find out more. So that's the next top event that's coming up for the markets and for the US. So anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video. And I'll see you guys around. Cheers. Bye.